Hello everyone and welcome to This Week in the Markets. In this video, we'll discuss the results of the European Central Bank rate decision meeting last Thursday and what the central bank has in plan for the 3-year-old debt crisis in Europe. We'll also go through the economic data that came out from US over the past week and also the implications for the market. But before then, we'll need to go through our disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So markets were expecting some significant actions from the European Central Bank during its meeting last Thursday, because of Mario Draghi's speech in the week before where he said that the ECB will do whatever it takes to preserve the euro, and also his assurance that, believe me, it will be enough. Much to their disappointment, the ECB did not take any immediate actions and did not even cut the benchmark interest rate lower. But Mario Draghi did give a few indications on what the ECB plans to do with a few conditions. Firstly, he confirmed the speculations that ECB is prepared to buy Italian and Spanish bonds on the open market, but only after the Eurozone government has activated the bailout funds to do the same. The central bank would also focus mainly on short-term sovereign bonds to ease any immediate funding fear, while keeping the pressure on longer-term bonds to push governments in questions to enforce stricter fiscal and economic reforms. Investors' concern of the central bank's seniority over private bondholders in the case of a default, such as when the ECB refused to join a write-down on Greek debt, would also be addressed, although at this stage Draghi did not mention how the ECB will address this. There were also mentions of non-standard measures to rein in the Eurozone crisis, such as an unsterilized purchase of sovereign bonds, or otherwise also known as quantitative easing. So far, all ECB purchases have been sterilized by collecting an equivalent amount of interest-bearing deposit, but unsterilized purchases would give the bank more capacity to purchase bonds in the bond markets at the cost of devaluing the euro. He also warned that any actions will not take place until September at least, because of the time required to set up the appropriate infrastructures and to get approvals from governments. If we were to summarize Draghi's comments in one sentence, we can say that while there is no actions yet, the ECB has set the guidelines such that if conditions worsen in the Eurozone and if any countries does require its help, it will be prepared to support them and be able to take adequate actions. There's of course still the questions of whether the government in the Eurozone would support the ECB bond purchase program, especially for Germany, who has previously objected to such program. When Mario Draghi made this announcement on Thursday, Angela Merkel was on vacation, so there were no direct replies at the time. But on Monday, one of her spokesmen told reporters that Merkel was not worried about the ECB's proposed action, which implicitly suggests her support to the program, or the government's support to the program. Another big news last week was the non-farm payroll report in US, which came in better than expected. This is positive after 3 consecutive months of falling below consensus. In last month's report, the US added around 163,000 jobs in July, which is significantly above the 100,000 jobs expected by analysts. To be sure though, this is not a figure that will support a strong and growing economy, but it's still positive to see that it is above 100,000 level again, and helps us to justify that markets are being overly pessimistic about the US economy. On the other hand, there are also a few negatives in the jobs report on Friday. Firstly, June's employment numbers have been revised even lower from 80,000 to 64,000, which is a cut of 20%. The non-farm payroll are often subject to multiple and large revisions, so the margin of error also tend to be quite large, so it may be a bit early to celebrate the jobs gains at the moment. Also, the unemployment rate rose 0.1% to 8.3%. However, this may be a little bit of an overstatement as the raw numbers only rose from 8.22% to 8.25%, which is a gain of just 0.03%. But because the unemployment rates are usually rounded up to 1 decimal point, that is why it appears as if the unemployment rate rose 0.1%. Overall though, this is a positive report, but the margin of error is high, so we do not usually use it solely to judge the strength of the economy. Nonetheless, market does pay a lot of attention to this report, so it is still a very important report for us to watch in the sense that it could change the short-term market sentiments. The ISM non-manufacturing index was also reported on Friday and was also better than expected at 52.6. Just like the ISM manufacturing PMI, above 50 on this index means that the sector is expanding, and below 50 means that it is contracting. So it is positive to see that the service sector in US is still in expansionary territory. In some sense, this is more important than the ISM manufacturing PMI, for the US economy at least, because service sector accounts for almost 80% of US GDP last year. And also another less popular economic indicator that was released on Monday also supports the growing economy and improving jobs market in US. As you can see here, the jobs opening in US rose in June to the highest level in 4 years and was the most since 2008. This data tends to be a bit more forward-looking, obviously as advertisement of jobs will come before the jobs itself. And there are no guarantees that each of these jobs opening will eventually be converted into new jobs, but at least it made us a bit more optimistic for the second half of the year in terms of the jobs market in US. The Bank of Japan kept its monetary policy steady this month and refrained from increasing its asset buying program. This was much in line with expectations, so the market did not move much on this news. When we're looking at the intraday chart of the dollar-yen today, we saw something that struck us as being quite interesting. As you can see from this 4-hourly chart of the dollar-yen, since late June, there have been multiple times where the cross spiked up over a short period of time and then gradually drifted lower again. It seems like someone or something is buying aggressively whenever the dollar-yen falls near the 78 level. Well, there is no proof for this, but we suspect that it might be a stealth intervention conducted by Japan. They previously admitted to conducting such intervention in November, and also claiming that stealth intervention was the most effective way for the government to push down the value of the yen. But whatever it is, the fact remains that there are strong support at 78 for the dollar-yen, and even if this level is broken, it will merely mean that the Bank of Japan will be more likely to take on more aggressive actions to support the dollar-yen or to weaken the Japanese yen. So we think that this is an interesting cross to keep on the watch list and to keep watching this. And that's all from us this week. There will be plenty of economic data next week from US and Europe on inflation and retail sales, but fortunately no central bank meetings from the G7 countries, so trading should be relatively tame compared to what we have in the past 2 weeks. We'll have another update next week on Thursday. Until then, on behalf of the Trading Pursuits team, we wish you all a profitable trading.